Hey, I'm the CEO of Yield School, and in this video, you're going to see Jeff, who is a Yield School associate, do a masterclass on maximizing portfolio returns via liquidity pools in the primary crypto markets. And Jeff sets strategies for several private crypto funds for Yield School members and even some of the investors on the Yield School team. And so his strategies are operating right now on millions of dollars worth of crypto. He is a top 0.01% expert in this area. And so by the end of this video, you're going to see how a crypto native pro really maximizes the return potential of his portfolio. And of course, none of this is happening on Coinbase. This is all happening in the primary crypto markets. In the video, you'll see Jeff start off talking about how to handle impermanent losses, which is something how a lot of beginners lose money when it comes to making yield in these markets. And then he does the math step by step to show how to use liquidity pools to maximize USD returns by just holding a simple asset like ETH. So this is actually pretty advanced stuff that is really difficult for crypto investing beginners. And at Yield School, that's why we have guys like Jeff and our team who can break down the best strategies in the market.
Hi guys, my name is Jeff. I'm an associate at Yield School, and I've been doing a lot of research in my times in the primary markets on liquidity pools. So I thought I would share you a video with my framework on how to look at impermanent loss and the first little practical possibility or tool that you can use liquidity pools for. So I've got a lot of messages as well asking for how do I generate yield, how do liquidity pools really work, because it's quite complicated. And yes, the theory in the books is quite complicated, and I'm going to try and simplify it as much as possible. We'll go through some math. I'll try and make it as quick as possible. We're going to use some easy numbers for you to get a good visualization and make it worth your time. So let's dig in. First of all, there's going to be two things that we're going to look at that I'm going to use as a whiteboard. The first one is TradingView, which is a charting software. So we'll look at a price chart. I think most of you guys already know how to look at price charts. For the people that don't, the candlesticks are the price of the assets. So today we're going to look at Ethereum. And the pool that we're going to use will be Ethereum USDC. So there's a W in front of it. It's wrapped ETH. This is just to simplify things. It's the same asset. It is Ethereum, even though it is wrapped. This is just a very easy way to not use your gas fees in your wallet. So let's say you want to make a pool with Ethereum USDC and you use ETH, the asset, and you would put 100% of all of your ETH that you want to deploy, then all of a sudden you don't have any gas ETH anymore to use as gas. So that is why we use wrapped ETH. But it's basically Ethereum, and it will be in combination with USDC in a liquidity pool. The investment that we'll do is 1,000 USD. The price of entry will be $2,500 per ETH. The range high will be $3,000 per ETH, and the range low will be $2,000 per ETH. So as you've seen, I really like to draw out my liquidity pools on the TradingView chart. It makes for a good visual and I can follow along. So as long as price stays in my little box here, I am generating fees, right? Once it goes out and it's out of range, the liquidity pool does not generate any fees anymore. I will not go very deeply into all of the math of impermanent loss, but we'll go over it. So the first thing to note with the liquidity pool is that when price goes up, it will sell the asset that goes up in price for the asset that underperforms. So it doesn't really have to go down in price, but that underperforms. So the outperforming asset gets sold for the underperforming asset. So in our liquidity pool, when price would go up from our entry, which is like the blue horizontal line, which is $2,500 per ETH, if ETH would go up, the liquidity pool or the constant product market maker, the algorithm, will automatically sell our Ethereum for USDC until the pool consists of 100% USDC at the top range, right? So once we reach 3,000 or up, it stays at 100% USDC. What happens in the inverse? Of course, the algorithm will start selling USDC So you will start buying ETH. So you will start selling USDC until at the bottom range of your liquidity pool, it will consist of 100% in ETH. So basically, as Reed already said during his plays and profits as well, the algorithm automatically takes profit when price goes up, and it will automatically buy the asset, so it will DCA it will accumulate the asset when price goes down, right? A complicated way to say this is that you reduce your delta exposure when price goes up, right? So when price goes up, you reduce your exposure on the asset that goes up in price, and you increase your delta exposure when price goes down. Okay, so for a lot of people, this is pretty negative because you increase your exposure, you get more exposed to risk the more an asset loses value, and you get less exposed to risk the more the asset goes up in price. So this might be quite the inversion of what you will like to have from a liquidity pool. And this is something that you need to integrate because there's a lot of positives as well. Big positive, of course, is that you're accumulating an asset. Therefore, as Reed said in his plays and profits as well, it is very important to provide liquidity with these strategies into an asset that you're okay with holding for the longer term, that you're okay with accumulating. Because if it is an asset that you are not interested in, if price goes down, well, your exposure goes up and you'll most likely leave the pool with 100% of the asset, right? So if you do not want to accumulate that asset, it will be very hard to be profitable or leave that pool with a good feeling. Okay, so that is rule number one. In this basic first strategy of liquidity pools, only provide liquidity for assets that you're okay with holding at a later moment in time. So that is the first rule. When price goes up, it sells the asset that goes up in value for the asset that underperforms, and vice versa when it goes down. So the IL theory, the theory on impermanent loss that complicates things in my view, is that it will compare us, the liquidity pool, versus someone holding 50% of asset A. In our example, it's USDC, and holding 50% of asset B, which in our theory is, in our chart, is ETH. So basically, how is the liquidity pool performing versus someone holding 50% USDC and 50% Ethereum? For me, this is very unlogical because in practice, it is way easier or way better to basically look at how you perform versus someone holding 100% USDC or versus 100% ETH. And this will make more sense, I hope. And that is why I use this as my example. So I don't look at impermanent loss versus 50-50, but I look at impermanent loss versus token A holders or token B holders to see how we perform against those. Why? Because this gives us better information on who made the decision. There's always, if price goes up or price goes down, there's always a winner and a loser. Of course, if price goes up on the asset, the winner is the person that holds 100% Ethereum because his portfolio value goes up. But if Ethereum goes down in value, of course, the big winner is the person that holds 100% USDC, right? Because he still got his dollar value and he can accumulate more Ethereum now at a lower price. So he's the big winner. So how are we faring in between that? Well, I forgot to remove all of the fees, the information here, and we're going to do it again step by step for you to follow along. And for that, for the value of the liquidity pool, I will use an outside calculator, which is DeFi Lab, which I'll share soon, so that you can follow along how the liquidity pool actually sells the asset. So, first of all, there's 3 scenarios I've drawn out. 3 scenarios that price can do. The first one is a green scenario, which price goes up, right? It does not touch the bottom, but it touches the top. It reaches the top side after a while, after certain periods of time, which is the box, right? The second scenario is a sideways scenario. So we start at $2,500 per ETH, and we end up again at $2,500 per ETH. This, of course, does not happen very often, but it is a possibility. And then the third scenario is a bearish scenario, where we start at $2,500 per ETH, and we touch, after a certain period of time, we touch the bottom side or the bottom range of our liquidity pool. So basically, what we're going to calculate now is how do we perform versus every scenario versus a holder of 100% ETH and 100% USDC. We, the LP, so the liquidity provider or the liquidity pool, that is us. So let's calculate. So someone holding 100% Ethereum at $2,500 per ETH, and price goes up to $3,000 per ETH. Remember, that is our range high. So it's 3,000 USD per ETH. So it goes up by 20%. Right? So a 100% ETH holder will have, and I'm going to draw up my calculator. He can buy, so $1,000, right, divided by $2,500 per ETH. He can accumulate 0.4 ETH at the price of $2,500. So 0.4 ETH. And what is that 0.4 ETH worth now at $3,000? Well, let's get our calculator back up. 0.4 ETH times $3,000. He made 20% on his move. So he made 1,200. He made $200. His portfolio is now 1,200 USD. Then the holder of 100% USD, well, price of Ethereum got up, but of course he wasn't exposed, that person. He was in USD dollar value. So his dollar value stays exactly the same, and he can buy less ETH with it at the top price, right? So he lost in Ethereum. So he started with 1,000 USD. And right now, how much ETH can he buy? Well, he was able to buy 0.4 ETH here, but now at the top range, how much ETH can he buy? Let's see. So $1,000, right, divided by $3,000 per Ethereum. That means he can only buy 0.33 ETH now. So he lost Ethereum, 0.33, repeating ETH. So he lost Ethereum value, right? And then the LP, well, that's going to be a different story. For what we will use DeFi Lab or a calculator for it, this won't be as important for you guys, but it gives you a right visual of what is happening. So remember, we need to calculate the price of our liquidity pool. If we opened up the liquidity pool at $2,500 per ETH with these ranges, 3,000 to the upside, 2,000 to the downside, what happens if price goes up to our top range? That is our first scenario. So let's check it out. So this is DeFi Lab. In DeFi Lab, you can put in some of the criteria. So our liquidity pool here on the left side is wrapped ETH USDC. The base token is USDC. The investment is 1,000 USDC. Current price at which we opened the liquidity pool is $2,500 per ETH. And the bottom range is 2,000. The top range is 3,000. A little caveat here. I know it's not exactly 2,000 or 3,000. It is because liquidity pools work with ticks. And so it is with brackets of, you cannot have an exact dollar amount. So we always need to take the closest dollar amount that we can find. So this is 1,994 or 2006. The tick of $2,000 per ETH does not exist, so it's in brackets. So don't worry, don't panic if it always jumps and you think, oh, I made a mistake. You didn't, it's just the algorithm that cannot give you the exact dollar amount. Okay, so we take the closest one. So the closest one is 1,994, and the max range, the closest one is 2,998. So what happens? You see a lot of complicated graphs here, but the one that we are going to look at is one, I can give you the visual. So the red line is where we start. That's $2,500 per ETH. And when price goes up to the right side, you can see that when price goes up, so now we're at 2,600, our USDC value goes up. It's going to be way more clearer with the new, the other calculator down. So this is our liquidity pool. On the left side, it consists, purple is the amount of Ethereum. On the right side is the amount of USDC. And remember, when price is in the middle, right, we have around 50-50. So we start at $2,500 per ETH. And we go to the right side of it, right, because prices rise. So we start with 0.16 wrapped ETH. And the wrapped ETH value goes down slowly. And the USDC value goes up. Do you see that? So I know it's very, very small, but it is selling your ETH until at the top range, you're at 0 ETH and 1,042 USDC. So again, we start at 2,500 USDC at around 16 Ethereum and 600 USDC in the pool. And then at the price of 2,700 USDC, now we only have 0.10 Ethereum and 750 USDC already. And so the Ethereum gets slowly sold off for USDC until at the top range, which is the blue line here, we have 0 ETH left in our liquidity pool, and we sold everything. And the total value of the liquidity pool now consists of 1,042.73 USDC. So that is the value of our pool. So that is the data that we need. So our pool value consists of 1,042.73 USDC, right? And how much ETH can we buy with that? At the top side, it's calculated. So we have 1,042.73, right? For $3,000 per ETH, we can buy 0.347. So it's 0.347. 0.347 ETH. Nice. So what you can see here is that without fees generated, right? Because fees will be an extra here. But I want to imprint it to you guys that you can use liquidity pools even if you don't generate any fees, and that fees are just an extra instead of something that you work towards or just work with. Because most people use liquidity pools only for the generation of fees and do not understand the basis or the real workings of, or the repercussions of using a liquidity pool. So this is what I want to teach you first. So compared to someone holding 100% ETH, 100% ETH is a clear winner here because price went up. That portfolio consists of 1,200 USD now. That is the big winner. That portfolio has gone up by 20% because price went up by 20%, right? So his delta is 1. He's completely exposed. When price goes up 20%, his portfolio goes up 20% as well. Very good move there in the bullish scenario. The person holding 100% USD or the other asset in the liquidity pool, well, he didn't make anything. In dollar values, you still have the same dollar value. And if you wanted to accumulate ETH, well, now you have a problem because you can only buy 0.33 ETH now. So he's the big loser, right? He's the loser. He wasn't exposed to the market. He wasn't able to profit from the 20% upside. And worse than that, he has now less ETH value. Right? He can buy less ETH with USD. And then there's us. We are second, right? We are in the middle. We do better than the one holding 100% USD because our value consists of 1,042.73 USDC now. And we can buy a little bit more ETH, of course, right? We can buy 0.347 ETH. We do worse than the number one, the first one, but we do better than the loser. So again, we do better than someone holding 100% of token B, and we do better, worse than someone holding 100% of token A. So what we forget here, of course, is that we need to add the fees generated in our liquidity pool. And that is something that we will do now. So this is something that is almost impossible to predict. And that is why I do not want you guys to only focus on fees generated, because it is unpredictable. On what is the amount of fees that you will generate based? Number one is volume, right? So how many traders use your pool. And 2 is the fee tier of your pool. Fee tier of the pool. So how much does your pool charge per trade? Now, we can go very, very in-depth in the fee tier of the pools here. What I would like you to do, because you're just starting out, is to use the fee tier that has the most volume there. On Uniswap, it will automatically calculate that fee tier for you. And on Orca and Solana, you just take the pool with the highest amount of volume. You can filter on volume on the pools there, and you can click on that one for now. So don't complicate things too much. But so the amount of volume or the amount of traders using your pool, of course, is not a fixed thing and is very difficult to predict. But we can look at past data, always look at past data to give you a good idea of what it could be. So let's check that out. Let's see how much this pool could generate in fees. So let's check out DeFi Lab. And this is a very rudimentary calculation. I'll explain how it goes on DeFi Lab. There's a better way to do this, but this is the simplest one. So I'm going to move I can leave my head here. So when you see on DeFi Lab, you have a concentrated liquidity multiplier. If you followed along on the Plays and Profits presentation of or live stream of Reed, you know that there's 2 ways of providing liquidity. The first way of providing liquidity is on the full price range. So we do not have a specific range. Basically, the liquidity pool would be infinite, right? It's like this one, very, very large. And it would go from 0, right? 0 to infinity. So it's not possible for me to draw infinity, but it would be the whole price range, right? So your liquidity, you can see it a bit like a glass of water, right? You only have so much. You have a liter of water, and if you spread it all along the floor, it's very, very spread out, right? It's not very efficient. If you put it in a long drink glass, that same amount of water will do more work. So this is what we're doing. We're putting that liquidity in a long drink glass. So more of your liquidity is working around the center of the price instead of spreading it out on the floor where the price is just a very, very small part of the area you provide liquidity in. So it's very inefficient. That's why the fees are way lower in a V2 pool than in a pool where you concentrate your liquidity in a range. Okay, that is the mindset behind it. So do you see the concentrated liquidity multiplier here? This means that our liquidity pool with our range is 10.31 times more efficient than the full range, right? So this is 0.0 to infinity. Ours is 10.31 times more efficient. Okay, so what we can do now is basically look at, in the past, what is the APR or what is the fees generated by a V2 pool, so by a pool from 0 to infinity on Ethereum USDC in the past. So we can check that and we go all the way to the bottom. So unbounded is our V2 pool, right? That is the full range. What can we see? The full range made 6.47% a year on that liquidity, right? 6.47%. So what we need to do now is to take that 6.47%, and remember we're 10.31 times more efficient, right, than UniV2. So we need to take 10.31, and we're going to multiply it by 6.47%, because that is V2, and we're more efficient, 10.31 times more efficient. So what is the APR that is expected in that range? It is 66.7%. That is nothing to scoff at, right? So that is quite some amount of fees. So we're going to integrate those. Whoops. So we're going to integrate those in our chart. So the fees are around 66% APR, right? 66% APR. And what is now the difference between us and the winner? Well, us and the winner is, so we have 1,042.73 USD. The winner that held his ETH has 1,200 USD. So what is the difference? The difference is 1,200 USD minus $1,042.73 is 157 point, what was it? 27 USD. So basically what we can do now is, first of all, you didn't make a directional decision, right? So you really didn't know where price of Ethereum would go, and you come in second. So you didn't make the bad choice, but you didn't make the good choice either, right? Or you didn't make the best choice either. You made a good choice because you've beat the worst choice there. But how can we beat even the best choice? Well, in that liquidity pool, we would need to generate $157.27 in that range, right? In that time period. So how long does the price of ETH need to stay in that liquidity pool to generate $157.27 at 66% APR? Well, let's see. So we make 666 USD per year, right? So how much is that per day? Let's see. So let's calculate. So per day, 666 divided by 365 is $1.82 a day, USD per day. And so how many days do we need to be in range to make 157.27? So $157.27 divided by 1.82 for every day, we get 86 days, right? So we need 86 and a few, 86 comma something. So to make it up would be 87 days in range to win. And that would be 87, a few months. Let's say 3 months, right? Beautiful. So to win here, to be the big winner, and this is what I want you to be able to click, is that you're already second without any fees, right? So people that made a directional bet, the guys that knew 100% that Ethereum went up, well, of course they bought Ethereum, but no one knows exactly what the price is going to do with 100% certainty, right? But these guys made the right choice, they make 20%. The guys that made the wrong choice and thought Ethereum would go down in the short term and they would be able to buy more, well, they lost. They didn't get any exposure, and they lost a significant amount of Ethereum, right? They lost 20% of Ethereum that they could buy, Ethereum value. What you did, you won 4.2% upside, right? And you lost way less. You lost maybe 15% of ETH value, okay? So with the fees, this is without the fees. With the fees generated every single day, you gain $1.82 on that, right? So you close the gap every day between you and the winner by $1.82. So every day that pool stays in range, the closer you get to the winner, right, of that strategy. So in total, you would need 87 days, so around 3 months of Ethereum staying in the price range between $3,000 and $2,000 to beat the person that made a directional bet. So if you're not sure where the price goes, and most of the time you're unsure, you can open a liquidity pool. You can calculate, well, how much value would I have if price goes up? I'm fine with only 4.2% instead of 20% when price goes up, because I can win in both ways. I can do better than the loser in both directions. And the longer I stay in my liquidity pool, the more fees I generate, with even a possibility to beat the winner if my range stays long enough in there, right? So this is great for accumulation if you want to accumulate more ETH, but you're unsure if price goes down. Because if you're unsure that price goes down and you think, I really want to hedge myself against Ethereum just going up and never make it to my limit order, and thus always having to chase price to the upside, just make a liquidity pool, right? Because if price goes down, you will still accumulate ETH. Granted, you will accumulate less ETH than someone holding 100% USD at that price and only buying it here, but you will accumulate more than someone buying Ethereum immediately here, right? So basically, we could do the same thing for all of the others, right? For the other scenarios. But what is basically going to happen is that here in a bearish scenario, of course, 100% ETH will lose. These guys will have 0.4 ETH. But $800, 800 USD, right? These guys will have 1,000 USD, and they will be able to buy more ETH. They will be able to buy 0.5 ETH at $2,000, right? So they win in ETH. And we are going to be in the middle. We are going to make around 855 USD, and we will be able to buy around 0.42 ETH, right? And in sideways, but this almost never happens, is 1,000. This guy has 0.4 ETH, still at 1,000 USD. This guy is 1,000 USD, still 0.4 ETH. And what we have is still 1,000 USD plus fees, right? And this is actually pretty important. I still want to take some time to explain sideways. So this scenario is what 99% of players in the primary markets focus on when providing liquidity. The big belief of most of participants in liquidity pools is still that liquidity pools are only profitable if price does nothing, right? Because you can only win. So this is where the liquidity provider wins in sideways action. But this almost never happens, right? So it's not really a real scenario. So that what I want you to do is to comprehend that you can win by still being second. You do not lose, right? When compared to someone holding asset A or asset B in different scenarios. And that fees generated can make you the winner even though you did not make a directional bet. So you did not risk the family farm in a position hoping that it will go down or up, but you will always be Malcolm in the middle. And if you provide liquidity for an asset that you would like to hold later on, you basically cannot lose, right? And that is the essence of what I want to give to you. And what I wanted to teach in this video is fees are an extra that can make you win in some scenarios. And you might think, well, this almost never happens. Sometimes it does. It is not a low chance. It is around 20 to 30% of the time that through liquidity provisioning, you even win against the people making the right decision because price stays in range long enough for you to close the gap. So for you to make $157 here, the 15.7% that you missed in liquidity fees. Hope this makes sense, guys. You know where to find me for any questions, and happy to see you soon.